welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Indranil Pan, Chief Economist at Yes Bank, joining in. Welcome to the show, Indranil, and always a pleasure to speak to you and get insights from you. Indranil, my first question coming to you is with regards to where the RBI policy that happened last week is concerned. They've clearly kept rates on hold as widely expected and also voted to continue with the accommodative stance until growth returns on a durable basis. What do you make of this, and how do you see the actions fructifying in terms of growth?
Yeah, so I think you have raised a very difficult question in terms of the last sentence that you mentioned, how far the action actually sort of helps propel growth. Now, I think from a policy perspective, it was the most pragmatic policy that the RBI could have come up with. And the very fact that they have left rates unchanged along with the stance also unchanged. A lot of people were expecting that the language to the stance can actually be changed. So even if it is a accommodative stance, people were expecting that accommodative, as long as it is necessary, would perhaps be removed to a more just saying an accommodative stance, which could have set the stage for the RBI to turn neutral in the next policy or sometime pretty soon. So that's the good thing that the RBI has done, that they've clearly said that we are there for the system. Having said that, with all this policy easing that has happened and all these months of sort of adequate liquidity, low rates, credit growth hasn't picked up in any significant way. And on the other side, we also see some of these measures, the emergency measures related to the COVID, which is the guarantee scheme for credit growth, as well as some of the measures that the RBI had come up with in terms of pushing liquidity to where it is due. Those measures actually continue. So there seems to be I think what the RBI is seeming to say once again is that there are certain segments which still needs a lot of support, but there could be other segments which probably don't need as much support. But from a policy perspective, you can't have differentiating policies, and therefore the policy remains where it is. And we will have to wait for a certain period of time and hope and expect that credit growth happens and the system comes back to a more durable and sustaining growth pattern.
Right. So overall, growth is largely playing out in line with what the RBI expectations are. And for FY22, I think they've kept it unchanged at 9.5%.
Yes.
What are your expectations in terms of growth with regards to FY22? And overall, if you see in terms of the coming quarters as well, how are you expecting the graph to look like?
Okay, so I think the growth story also is sort of, to a certain extent, according to me, maybe turning out slightly uncertain. Simply because of the very high input costs that most of the industries are facing today. And along with that comes the coal crisis and the way the coal crisis would likely play out. And we will have to watch out to see if there are erosions in the output for various industries as a result of the coal crisis. But having said that, even if there are no erosions in output, I am not sure how much and how far manufacturers will be able to pass on the higher input cost to the end users, simply given the fact that demand is still fragile. That's also a point that clearly comes out in the RBI statement of the monetary policy. Now, given that situation, I'm not sure whether we once again would likely see some amount of profit growth erosion of the companies, something that we always factor in when we look at the GVA. So that's the concern that I have in terms of growth at this point in time. And after the first quarter growth number, we have slightly upped our own growth estimates to an 8.8%. We will be looking at the growth numbers that comes out from the official growth numbers that come out for the second quarter to make any further changes. But at this point in time, we are happy with an 8.8%, which is slightly lower than a 9.5% of the Reserve Bank of India, but slightly much more lower than what the government expects the growth to be.
Right. And with this, in terms of in terms of inflation as well, there has always been a dilemma whether to focus on inflation or whether to focus on growth. And now the RBI has clearly stated that yes, they will see to it that the inflation remains within the targeted range. And they've revised down its CPI forecast for FY22 as well to almost, I think, 5.3% from a 5.7% earlier. So, do you think it's going to be easy for them to focus on growth and inflation simultaneously?
The very fact that they have brought down the inflation forecast, in my opinion, clearly indicates that the RBI is relatively getting more comfortable with inflation. And purely because of inflation leading to a change in the monetary policy may not be a likely situation. So I think that, in my opinion, even further cements the RBI's sort of perspective with respect to growth, and that's the reason you possibly also see the stance as being maintained as much as possible and as long as possible, unless a durable growth momentum comes back to the economy. Even at a 5.7%, the clear messaging from the RBI's perspective, in my opinion, was that till the point in time we are within the band, it's no longer the 4%, which is what we are targeting. Till the point we are within the band, we are within the upper threshold of 6%, we are comfortable, and we will probably be willing to look through the noises around the inflation, which is more a supply-led and a commodity price-driven inflation at this point in time, rather than a demand-led story. And I think the last point that I need to mention here is that once again in the policy, there has been a plea to the government in a slightly tangential fashion to say that please bring down the prices of petrol and diesel by cutting taxes. That's the only way we will be able to ensure that inflation expectations don't play truant in the current scenario.
Right. So overall, with all of this, if you see in terms of the liquidity as well, there is excess liquidity in the system, on the back of which the RBI has decided to suspend GSAP operations. However, they've said that they will have commitment with regards to OMOs, Operation Twist, and additional GSAPs if required. Taking the additional liquidity into consideration, taking into consideration the growth and the inflation forecast and the outlook that we have, how do you see the policy normalization to be from here on? Do you think it will be sudden? Do you think it will be in a gradual, phased manner? And when can we see RBI increasing rates?
Yeah, so number one, no central bank around the world is possibly in a situation to provide a sudden sort of change in the monetary policy. So that's very clear. And so is the Reserve Bank of India, where I think Governor Das has made it amply clear that they are not looking at any sudden changes in the policy, and the policy steps will be pretty much guided and conveyed to the market much beforehand. Now, having said that, I think in terms of the normalization, yes, the first attempt at normalization is through the liquidity, which was anyways a likely scenario. With the VRRR, I think in this policy, they have guided to overnight liquidity of about 2 to 3 trillion. In the previous policy, they had guided a liquidity of about 4 trillion. So that's another way of looking at the very fact that the RBI is willing to bring down the overall surplus of liquidity in the system. The third thing, of course, is that the RBI clearly also mentions that VRRR is not a total withdrawal of liquidity, that liquidity is still available in the system. And therefore, if there are liquidity concerns, they can play around with the VRRR in terms of both duration and the quantum to either suck out more liquidity or sort of comfort the market with a little bit of more liquidity. The confusing fact at this point in time is how the inflows side will play out from a capital flows from the rest of the world. On one side, we have a significant number of IPOs lined up, so that could bring in capital. But on the other side, we have the US Fed normalization to start through sometime, which could actually drain a bit of capital from the emerging market economy. So that I think remains the confusion from an RBI perspective.
Right. And with all of this, the first quarter FY22 current account surplus was at 0.9% of GDP. Slowly, steadily, we've started turning towards deficit, and FY22 CAD is seen at around 0.8% of the GDP. Now, the swing from a deficit in the fourth quarter of FY21 to a surplus was mainly on the back of the second wave in India, which pulled down import demand, even as the exports were supported by recovery in the overseas market. And now that we are going back towards a deficit, what does this entire trend actually tell you?
Well, I think one of the reasons for the surplus also, as you rightly said, was exports, which was at about 35 billion odd dollars for every month. Now, that was definitely on the back of a significant growth in the world merchandise trade. As the world normalizes in terms of growth, there could be some amount of erosion in terms of the exports that go out of India. So some moderation will happen to the export side. On the other side, the import pull more would be from the commodity prices rather than anything else. So but the point very clearly is that it's more a price pressure on the import side rather than volumes on the import side. So first of all, I think the current account deficit stroke the current account surplus may not be a clear indication of how growth is panning out. Having said that, I think the external sector, even with higher deficits or deficits once again turning back into or current account turning back again into a deficit scenario, is unlikely to pose much of a problem in terms of the external sector dynamics as well in terms of the currency movement, because the capital flows are expected to remain quite significant to provide a buffer to this.
Right. So, do you think that's something, along with the impending taper, put pressure with regards to where the rupee is concerned, and we will see a depreciation bias from here on?
For a developing country like India, you always need a depreciation because unfortunately, you will have to close the competitive gap either ways. Either it is productivity side or the price gap that exists between you and the rest of the world. So you need a depreciation of the currency. You can't sustain with an ever appreciating INR. I think the recent depreciation pressure of the INR is not because of your current account momentum or not because of anything that has happened on the balance of payments. It is to a certain extent because of the higher oil prices, which has dumped up in a very non-sequential, non-linear fashion and is likely to stay elevated for certain periods of time. And it is also factoring in the relative firmness of the dollar in the global markets. So most of the factors that are leading to the current depreciation is coming from the external conditions rather than the current account position for India. And that is how we would sort of expect to see the currency going forward. Very clearly, we are still looking at a 75.50 to a 76 by end of March. Fourth quarter may actually bring in some positivity back to the currency because you will have the IPO inflows coming in. A lot of services sector actually sort of brings in a lot of their income generated abroad back to the country. So relatively, I think we will have a more sideways behavior of the INR rather than the abrupt depreciation jump that you have seen over the last month or so.
Right. So overall, with all of this, the liquidity infusion is behind us. How supportive is the RBI going to be with regards to where long-term yields are concerned? Because in terms of the fiscal deficit as well, for April to August, we are around 31.1% of the budgeted estimation. And then, divestment, we don't know. There's always a if and but whether the divestment targets will be met through as well. So overall, taking the borrowing calendar into consideration, the divestments, as well as with regards to where the fiscal deficit goes, how do you see the entire gamut moving and impacting the yields?
Yeah, so I think for the long-term yields, I clearly believe that it is less of a function of RBI's rate policy. It is more of a function of the fiscal policy. Now that you have a relatively better comfort so far as your revenues are concerned, and your H2 borrowing program has not pointed out to any additional borrowing for the rest of the year, and that's what our belief is also. I think there will be a natural sort of upper threshold in terms of the 10-year yield momentum. Now, having said that, I think the RBI is clearly watching that space. And obviously, they will be open to, if not to the GSAP or the OMOs, they will be open to operation twist to sort of, I wouldn't say manage, but to restrict any abrupt sort of momentum of the yields in the long term, because they clearly know that that could also sort of negatively play with the yields in the rest of the economy, and therefore sort of negate whatever growth process we have sort of launched ourselves into. So I think our view is that 640 may be the upper level in terms of the 10-year yield. Yes, to a certain extent, the upward pull in the domestic yields is also because of the US 10-year yield having moved so strongly. So some of these behaviors will, as it normalizes and as the overall growth slowdown or normalization in the rest of the world clearly says and shows that there is an upper limit even to the commodity cycle, we might have a much better sort of perspective in terms of the domestic yields also.
Absolutely, and that's something we need to watch out for from here as well. Thank you, Indranil, so much for joining us on the show. Always a pleasure to speak to you and get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you very much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.